Good day to everyone. We are Group 1. Today we are going to discuss issues of financial reporting of banks, which is identifying significant increases in credit risk. Now let's talk about the meaning of SICR and ECL. In the context of IFRS 9, SICR is a significant rise in the estimated default risk over the remaining expected life of the financial instrument. ECL is the expected credit losses that result from default events. If credit risk has increased significantly since initial recognition, a lifetime measuring ECL is recognized, which may be significantly higher than a 12-month ECL. The assessment of what is considered to be a huge increase in credit risk, therefore may have a huge impact on the loss allowance recognized.
Due to the COVID-19 pandemic, the three stages approach is no longer applicable. Instead, a more likely method might be a collective assessment of qualitative factors and coverage, which focuses on the vulnerable part of the loan account. Because, assuming that all exposures in the first stage are transferred to the second or third stage, or that no exposure is transferred to the second or third stage, it is not appropriate in many cases. For example, providing a package of financial support to all borrowers of a certain category, such as all household mortgages, does not automatically mean that the credit risk of all such borrowers is significantly increased. SICR is based on the probability of default, not the probability of loss. For example, banks should consider plans that directly provide cash to borrowers quickly to reduce the risk of default, while plans that provide funds or guarantees to financial institutions and only mitigate the losses suffered by these institutions should not be considered.
What specific accounting standard that need to be used in solving the issue? Obviously it's used IFRS 9, financial instrument. The new IFRS 9, which is effective January 2018, is aimed at increasing the accuracy and transparency of how credit risk is represented on a company's balance sheet and P&L. Under the new regulations, companies will have to start making bad debt provisions for possible future credit losses in the first reporting period. IFRS 9 requires an entity to base its measurement of expected credit losses on reasonable and supportable information that is available without undue cost or effort. The significant increase in credit risk assessment must be carried out at each reporting date to determine whether the credit risk of a financial instrument has increased significantly since initial recognition. This is particularly important for instruments with a maturity greater than 12 months because lifetime expected credit loss will be higher than 12 months expected credit loss, resulting in a higher impairment charge in profit or loss. So, what does it mean for corporates? In order to assess for SICR, entities need to understand the key factors affecting the credit risk of their financial instruments. By considering both borrower-specific information and information about the general economic and business environment. Are there any simplifications that can be applied? Yes, two of the most relevant to corporates are: the requirements contain a rebuttable presumption that the credit risk has increased significantly when contractual payments are more than 30 days past due. And, if a significant increase in credit risk had taken place since initial recognition and has reversed by a subsequent reporting period, then the expected credit losses revert to being measured based on an amount equal to the 12-month expected credit losses. What are the ethical dilemmas or principles surrounding the issue? Supervisors and regulators may not play an integral part and may not want to contribute to public policy responses to the COVID-19 pandemic. Be inconsistent with their mandate. For example, like ensuring safety and soundness. In this matter, supervisors require a balancing act to encourage the bank to restructure loans. Thus, banks should work constructively with affected borrowers and supervisors should encourage prudent loan restructuring where necessary to sectors or firms heavily impacted by the crisis. It is important to note that the restructuring decision is a business decision by the bank, based on the assessment of the borrower's capacity to pay under the new terms. Banks should not be encouraged to foreclose loans, cease and liquidate collateral, using out-of-court mechanisms or legal proceedings. Instead, restructuring could take the form of renegotiated terms, maturity, interest rates, fees, moratorium policies, or grace periods or payment deferrals. A grace period to repay loans could help borrowers manage the temporary impact of the crisis. These types of measures fall under loan restructuring, which is standard practice when borrowers face temporary difficulties due to natural disasters, economic shocks, sectoral difficulties,